Assalamu alaikum friends, welcome to lecture 6 of SBR, and today the standard is IAS 8, which is accounting policies, changes in accounting estimates and error. These are three separate things. One is accounting policy, one is accounting estimate, the other one is prior period error, and how we are going to deal with these three things. This is a very short lecture, short and sweet, and something which is very easy. But in the exam, it's a little bit difficult to identify whether it's a prior period error or accounting policy or an accounting estimate. If you're able to do that, then rest is easy. Okay. So here we are going to focus on accounting policies, changes in accounting estimates, and prior period error. Also the problem with IAS 8. Starting with accounting policy. What does accounting policy means? See, accounting policies means every rule that you know, whether IFRS or IAS, they have certain accounting policies, okay, that you can apply to the transactions, okay. And where an IFRS standard is there, so based on that IFRS standard only you are going to uh, for that activity you are going to apply that IFRS standard. That's how you are going to show that you have applied the accounting policy. You are applying that IFRS standard. In each IFRS standard there is accounting policy that is given. Some IFRS standard gives you a choice in accounting policies. Remember, like IAS, what do I say? IAS 16, property, plant and equipment gives you a choice. Cost value, cost model or fair value model. Investment property gives you a choice, cost or the fair value model. So things like that. Wherever they are giving an option, some IFRS standard, not all. Some standards are fixed that you can only go by this model. Some, they give you a choice in accounting policy. So when they are giving the choice, our concern is when they are giving you a choice. When they are giving a fixed thing, that's okay, you just apply it. But where they are giving you a choice, for example, another example, let's say IAS 2, inventory. There they are not giving you a choice. They say you have to recognize inventory lower of cost or net realizable value, whichever is lower. Okay. But we are focused on those standards where choice is given. So when a choice is given, and whatever the policy you have selected, you might think that because you have a choice, select any policy, whichever is good for you. No. You have to select a policy that gives the most useful information to the user. Yes. When there is no standard, then what? Then management should use their own judgment to develop and apply an accounting policy. And whatever they have selected, whatever accounting policy, it should result in information that is reliable and relevant. Okay. And for that, management should, when there is no standard, management should refer to these two things. One is they should see whether there are similar standards which deals with standards that deals with similar or related issues. Go by that. Or the conceptual framework. For example, in the conceptual framework, they have given you how do you deal with assets, how do you deal with liability, how do you deal with income, expense, equity. So you will see what is it. It's an asset. So you will go to the conceptual framework, see how asset is recognized, measured, and you will see. Right? Now, what if those accounting policy changes? Changes in accounting policies, it can happen, but it does not happen frequently. There are exceptions to this case. Okay? Exception is only if it is required or it is required by the standard, or changing the accounting policy will result in more relevant and reliable information. Then only you can change the accounting policy. Otherwise, you do not change accounting policy. It stays consistent every year. For example, depreciation. You do not recognize depreciation reducing balance, one year reducing balance, second year straight line, third year reducing balance. Not like that. Let's say you have been recognizing depreciation using straight line method for 4 years. But in the fifth year, you think reducing balance is more, it gives more relevant or reliable information, or the standard says so. So you can change in that condition, right? Not all the time. This changes is very limited. But when it changes, how do you understand? How do you deal with it? That's the topic of this lecture. Okay? If there are new accounting standards, It includes transitional arrangements on how to deal with resulting changes in accounting policy. Okay, but if there are no transitional arrangements, nothing new has changed, nothing new has been translated, then what? Then changes in accounting policy should be applied retrospectively. That's why it's in bold. Third point is very important from your exam's point of view. Changes in accounting policy should be applied retrospectively. What does it mean? It means whenever there is change in accounting policy in your SBR question, in your SBR exam, go back and change the figure. You have to go back. Retrospective means going back, past. Go back and change the figure. How long? Just 1 year. Not entire 5 years or 6 years behind. No, you cannot do that. Go back, change the figure. And change the current figure as well. That is the meaning of retrospectively. That means you have to adjust your opening balance for each affected, only affected component of equity, whichever places has been affected, the opening balance, go and adjust, change it. Comparative figure also. What is the meaning of comparative figure? They will give you comparative figure. That means this year, if they are giving you the financial statements, they will give you the previous year also or the next year also. That is the meaning of comparative figure. They will give you. Okay, so and even those comparative figure you have to go back and change, not just the current year, past year also you have to go back and change, as if the new policy has been applied since then, since the last year. You have to show that it has been always applied, not just today or in the future. No. So after accounting policy, if you have understood that, come into the changing in accounting estimate. Okay, changing in accounting estimate. First, you have to know what are accounting policies, what are accounting estimates. Accounting policies are like that. For example, IAS 16 telling you to choose cost or fair value model. Accounting estimates are depreciation methods. That is accounting estimate. Okay. So, and you know, as an accountant, you have to make estimate when you're preparing financial statement. You have to, for example, how much your inventory will be obsolete, or what is the useful life of property, plant and equipment, or what is the allowance for the financial asset. This estimation. Okay. And a change in accounting estimate is not a change in accounting policy. Please do not confuse the two. Never. It is always done by the students. So according to IAS 8, please highlight in the bold word. There's a reason why I highlighted the word. I have made it in bold so that you never forget. Changing an accounting estimate is recognized prospectively, not retrospectively. Prospectively, that means you change the current figure and the future figure. Do not go back in the past and change the figure. Whether it is in the statement of profit or loss, whether it is in the statement of financial position. For current and future. Accounting policy was current and past. Accounting estimate is current and future. Understand this difference. Write it down. Third, prior period error. Prior period error means what? Let's say you have forgot to include something. That is omission. Or you have included something but the figure is wrong. That is commission. Error of omission or commission. Okay? In the prior period, that means previous year. Okay? So what happened? You need to correct this, no? There could be any reason. But prior period error, if it has happened, you need to correct it because it will have an impact later on if you stay on with that error. So what do? IAS 8 says if there is a material prior period error, please understand material. If the error is very minute, very small, you don't have to change it, I think. Right? But they will most of the time give you a material error only in the exam. There's no doubt. Why? Because if they do not give you a material error, how will you adjust it? Okay? Sometimes they will not write the word material. They will just say prior period error. Then also you have, as a default position, you have to take it as a material error. You have to change it. Okay? So this you will correct retrospectively again. Please understand, retrospectively means going back in the past and changing the figure. Current, obviously you will change. Retrospectively. So, what are the places that it will change? In the retrospectively, in the first set of financial statements authorized for issue after their discovery. That means after you have discovered that error, whatever the financial statement is there for issue, The first set needs to be corrected. So opening balances of equity, comparative figure, all this should be adjusted to correct the error. Now we are moving on to problems with IAS 8. What are the problems with IAS 8? The problem is mostly in the prior period, because you have to correct the prior period error retrospectively. It can lead to earnings management. What is earnings management? Managers can come and manipulate the financial statements. Like that, they can adjust any error. Maybe an error has not taken place, but they will come and adjust it. They might increase the profit by showing that there was an error. They were showing low profit. They might increase the profit in any year to get the bonus. Can happen, right? You never know. And another reason is because, remember, prior period errors are adjusted in reserves. They are adjusted through reserves, opening reserves. So because of that, the impact is never shown in the current period statement of profit or loss. So your profit or loss will be higher only, always, because you are not showing the impact of it. The impact of the error in the current statement of profit or loss. It is always through reserves. So that's a problem with IAS 8. Now, let us do 2 questions on this topic before we conclude the lecture. Test your understanding 4. Okay, so we just have one question. Okay, the other question I didn't do test your understanding 1, 2, 3. So you can do it on your own. It is just a knowledge question. What you have done from the lecture, just apply it. But this question is something which is challenging. So here you need to discuss whether the directors of the granium are correct. And this type of questions only you can expect in SBR. This is an exam standard question. So granium's production machinery has always been depreciated on a straight line basis. At the start of the current reporting period, they decide that depreciation based on units of production would be more accurately represent the resource consumed. So now they are changing their method. At this, the carrying amount of the production machinery was 2 million. However, if machinery has been depreciated using units of production, the carrying amount would be 1.5. The director wished to charge 0.5 additional depreciation to correct this discrepancy. To 1.5, they are adding 0.5 also. Okay. Additional depreciation. Discuss whether the directors of granium are correct or not. Tell me. What do you think? First, whenever a question on IAS 8 comes, see, first identify in an exam, if this question is given, know where they have mentioned which standard. They will not mention you also. That is a trick. Identify which standard. First, identify the correct standard. From which standard this question has been asked. Then only you will be able to solve the question. In any SBR question, this is the way you have to approach. Understand? They're talking about depreciation. They're telling about change in depreciation. Then they're correcting the depreciation. So this is IAS 8. First, identify the standard. Correct? Changes in accounting, policy, estimate, and error. IAS 8. Understood? After IAS 8, I'm showing you the way to this question. Identify whether it's a policy, estimate, prior period error. If you are not sure about this 3, at least eliminate the incorrect ones. So it reduces your option. This is not a policy. If it was a policy, they would have given you a choice. This or this. Here they have changed the method of depreciation. But that does not mean a choice is there. Choose this or that. Once you have decided you will go by straight line, you go by straight line. It's not a choice. There might be various methods, but choice is not there. So this depreciation, changes in depreciation is an accounting estimate. Remember. It is not a prior period error, otherwise they will clearly write it that in the previous year this error has been made. So this is an accounting estimate. Correct? Once you know it is an accounting estimate, you should know it is dealt retrospectively or prospectively. Prospectively. Prospectively means current and future. You do not go back and change. You only change in the current and the future. Current figure you change, and in the future you go and adjust. Correct? So, according to this, tell me whether this director is correct or not. You have to write according to IAS 8, changes in accounting depreciation is the accounting estimate. You have to write it in words like this. I didn't write it in words, I'm showing you in a diagram form, but you have to write it in full sentence. As the first para. Second para, tell whether director is correct or not. So in this case, if you are telling the director is correct, then my dear friends, you have a lack of understanding in this knowledge. You have to go back and revisit IAS 8. And if the ones who are saying this is incorrect, okay, clap for yourself. You have understood where we are heading, where you are heading. It is incorrect. The correct answer is this is incorrect. You have to write it. The date is incorrect, and you have to give explain reasons why it is incorrect. Why? Granium. Mention the name of the person. Granium is not permitted to do a catch-up adjustment of 0.5 million. Okay, that correct. But then you have to tell the correct treatment. Just saying incorrect and telling that incorrect treatment is not enough. Correct the treatment. What is the correct treatment then? This is the way you approach an SBR question. Any SBR question, because all SBR questions are like this only. Based on some transactions which is incorrect and you have to correct based on the standard. Some adjustments could be correct also, right? But very rarely you will see correct things. Otherwise, how are you going to correct, right? What is the purpose if everything is given as correct treatments, right? So anyway, what is the correct treatment? Instead, the remaining carrying amount of 2 million will be depreciated in the current and the future period using the new depreciation method. So whatever it is, what is the change in depreciation? Units of production. So based on units of production, this is the carrying amount. So now in the current and the future, you go and depreciate this 2 million because this is the new. Prospectively, you have to change, no? Current and the future. So in the current and the future period, using this new depreciation method, this 2 million will be depreciated, not the catch up of 0.5 million. Understood? In the current and the future, you have to write the word current and the future. Current and future is needed. That's why I've included everything. So that's it. Now let us summarize this lecture. So now let's summarize. We have started with accounting policies and we told they are dealt retrospectively, where they are giving you a choice like cost or fair value model. And some IFRS standard only gives you that choice, not all. Then we dealt with accounting estimates and told that they are dealt prospectively. We even have done a question in that regarding depreciation change just previously. And sorry, the accounting spelling it's a mistake. Okay, there's a spelling mistake, but it's okay. You understood, right? Then prior period error. It is also dealt retrospectively, going back and in the changing currently and going back and changing. So accounting policy and prior period error. These two are dealt retrospectively. All the accounting estimates are dealt prospectively, current and the future. Problem with IAS 8 earnings management. If you have to change the prior period error, it can lead to earnings management. They might, and earnings management is not good. It's a bad thing. It's an evil thing. So that's it for this lecture. Thank you for watching and see you in the next lecture, which is on IAS 10. And if you have not subscribed to my channel yet, please do so because you'll be getting all the lectures for your December session, December 2022. All the SBR lectures will be there.